Okay, this video is going to introduce to you corporations. So in the business news, what corporations have you heard talked about? Maybe Google, maybe Apple. You hear them talking about their stock prices. So they're talking about corporations that are publicly traded, and we're going to be talking about corporations that are publicly traded and that sell their stock. So stock is ownership of a business. If a corporation wanted to expand and needed additional capital, they can go out and issue stock. In exchange for giving up some of their ownership to shareholders, they receive the money from the shareholders. Alright, let's look at how this changes the words that we use to describe some things in here. So when we had a sole proprietor, we had a statement of owner's equity, and you may be familiar with this. We have beginning capital plus the owner investments plus net income minus owner withdrawals equals our ending capital. That was our statement of owner's equity. Now that we're going to be a corporation, we're going to have a statement of stockholders' equity. Stockholder is the same thing as owner, but for a corporation. Alright, we're going to break down our stockholders' equity into two sections. We're going to have a paid-in capital section and a retained earnings section. Under our paid-in capital section, that's going to be all of the money that came to us from our investors. Over here it would have just been owner investments. But now we're going to have some new accounts for it. We're going to have common stock, preferred stock, paid-in capital in excess of par, paid-in capital from treasury stock, and we will talk about what all those are, but what I want you to know right now is that these are accounts that came from our investors, and as such they go underneath the paid-in capital section of the stockholders' equity. The second section of the stockholders' equity is going to be retained earnings. This is going to be all of the earnings that we have retained in our business. So it's all of our earnings minus any that we have given out. So dividends are what we give out to our shareholders. They are comparable to owner withdrawals. The difference is that the company has to decide and declare to give a dividend to the owners, whereas here the owner was the business, and so the owner could withdraw it whenever the owner wanted to. Alright, we're going to talk about this treasury stock later on in the chapter, but that gets us to our total stockholders' equity. So stockholders' equity is made up of paid-in capital and retained earnings. That equals total stockholders' equity. There is a reason that we break it down like this. That is to let the users of our financial statements know, did most of our capital, did most of our money come from us selling our product or service and being profitable at it, or did we have to go out there and raise money from our investors, and is that where most of our money came from? So we want to be able to show where our stockholders' equity is coming from. Outside investors or from being profitable with our earnings. Alright, so now I'd like to go over a few more definitions. You will get to know these words as we go, but I want to have at least told you about them. I told you about dividend, I told you about common stock. I want to talk about that word par, because I threw it out there. Par is an arbitrary value assigned to a share of stock. So you may see something like, we have common stock, we have 100,000 shares authorized, we have 10,000 shares issued, and we're going to call it $2 par. Let me just tell you what all this means. In our corporate charter, that's when we first start our company, we have authorized to have 100,000 shares of stock that we can issue. So far, right now, we've only ever issued 10,000 shares to the public, so that's what's out there being publicly traded, and it was issued at $2 par. That is the value that we assigned to it, but it's only going to stay there until it gets out in the marketplace, and then once out in the marketplace, the price of the share will change every second. So as it's being publicly traded, the price will be determined by supply and demand. However, in accounting, we care about this $2 par that we originated it at because we're going to use that in our journal entry, and you'll see how and you'll see why in just a bit. Okay, the next videos we'll start to talk about each of these items and how we're going to account for them, how we're going to journalize them, and how we're going to compute the dividends. Let me know if you have any questions.